Okay, so good afternoon and welcome to today's BDO financial reporting update. My name is Annie Taylor and I'll be joined today by my colleagues Moses Surfety and Anthony Appleton, and we work in BDO's internal financial reporting team. A recording of the webinar will be available after the session, so we are recording today's session. We're expecting the webinar to last in the region of 45 minutes or so. If you would like to ask a question during the webinar, then please could you use the Q&A chat function, which you'll be able to access from the icons at the bottom of your screen. Time permitting, we'll answer your questions either during or at the end of the webinar. If we don't get time, then we'll respond to you after the webinar. So just one important thing to stress here is that if you absolutely want a response to your question, please make sure that you don't raise the question anonymously, because otherwise we won't be able to contact you. So what will we be talking about today? We're going to kick off with some considerations for the upcoming June 2022 interim reporting season, starting off with some IFRS changes that will be effective for the first time for those June 2022 interim periods. We'll then look at a recent Esma public statement that's been released that looks at how the implications of Russia's invasion of Ukraine should be incorporated into half-yearly financial reports, before concluding this section with a current topical issue looking at the implications of rising inflation. Then we'll have a IFRS and UK GAAP update looking at recent changes to those standards, before finishing with a section on other corporate reporting news, heading off with recent developments in the government's audit and corporate governance reform proposals, before looking at some useful and helpful publications recently released by the FRC. We'll then cover a new listing rule to improve the transparency of disclosure of gender diversity on listed companies' boards, and we'll conclude with a very brief sustainability update. So without further ado, I'll hand over to my colleague Moses Surfety to kick off the session on interim reporting.
Thanks, Annie. So, excuse me, we've labelled this section interim reporting, but if you don't, even if you don't prepare interim accounts, what we'll be discussing will hopefully be useful for you when you start thinking about preparing your annual accounts in due course for December year ends. So, what is it you need to think about in terms of changes to IFRS? Well, the key headline is that there's been no major changes or new standards that are effective for the current period. But as with everything, devil is in the detail, and on this slide and the following ones, we'll discuss some of the changes that you might want to be aware of. So on this slide, we've got the a list of the amendments that are effective. As you'll see, no major standards, but some tweaks to currently effective standards. This is a suite of amendments that the UK Endorsement Board endorsed back in April. That was their first endorsement activity. Up until then, it had been done by the Secretary of State. So moving on to the next slide. So on the top left-hand corner there of the slide, you'll see a reference to the conceptual framework and amendments to IFRS 3. Again, this is probably not something that will have widespread implications for most of you, but this was a change to IFRS 3 and the conceptual framework, and mainly affecting the recognition of contingent liabilities and provisions on a business combination. And all the amendment did was, like it says, changing the references to the conceptual framework, but also avoiding a potential issue on day two gains and losses. So again, not something that is expected to be widespread or have wide-ranging implications, but good to be aware of in case you've got any business combinations. Then on the top right hand corner, we've got the annual improvements to IFRS standards, and this is just a suite of minor tweaks that the ISSB does. I suppose in terms of ones to draw your attention to is the second one on the list there, IFRS 9 and the fees in the 10% test. So the 10% test is a test that you will do, let's say, if you have a modification to cash flows on existing debt, and this was a clarification that the only cost of fees that you would include in doing the test, and the test is when you compare the present value of the existing cash flows against the present value of the modified cash flows, that the cost of fees that you would include are those paid or received between the borrower and the lender. It also clarified that when you do have an extinguishment, i.e. the terms of the debt have changed such that you de-recognize the old debt and recognize a new one, any costs or fees would be included in the gain or loss and extinguishment. Again, something to be aware of. And again, it's also sort of a fairly limited application, but if you do have if you have renegotiated your debt, this is something to be aware of. The other two on this list, again, are just minor clarifications, which again, we don't expect to have too many wide-ranging implications. Moving on to the next slide, and we're covering here the onerous costs, cost of fulfilling a contract. Yeah, so this is an amendment to IAS 37, which was addressing which costs a company should include when assessing whether a contract will be loss-making. And before this amendment, it was unclear as to whether an allocation of other costs that relate directly to contract activities should be included in assessing whether a contract is onerous, or whether you would only include incremental costs. So what has this amendment said? Well, it says you include incremental costs plus an allocation of other costs that relate directly to fulfilling the contract. And this last bit is the bit that you may not have been doing in the past. As I said, there's been some diversity, so it's something to watch out for if you do have any onerous contracts. And I suppose in terms of if you're thinking about your interims, well, how is this amendment implemented? Well, the transitional provisions require a company to apply the amendments to contracts existing at the beginning of the annual reporting period. So we don't have restatement of comparatives, which is what we would normally have when you have a change to a standard. So how do you do that? You would say, well, do I have any onerous contracts? If I did, or if my assessment now, because of having to include these additional costs, means that a contract that I may have assessed last year wasn't onerous, is now onerous, you would recognize that provision in your opening balance sheet and take the adjustments to equity or to retained earnings. As always with these things, if you do have an adjustment arising, don't forget that to think about the impact of deferred tax on any adjustment that you may record. So again, not expected to be wide-ranging, but as we'll discuss a bit later on, we are expecting to perhaps see more onerous contracts, maybe as a result of rising inflation. So it is an amendment that it's worth being aware of. And like I said, it's a change in practice, but it's now clear. What isn't clear, I suppose, in my view, is, well, what are costs that relate directly to fulfilling the contract? So again, you might not have thought about this in the past because you didn't have to include these costs. Well, now you're going to have to think about this and perhaps develop an accounting policy as to which costs you would include in your onerous contract assessment. So moving on to the next slide, where we're discussing an amendment to IAS 16. And again, this one's also perhaps not as narrow as you might think, but in terms of sectors that will be affected here, we're thinking, natural resource companies where you might be have an asset that you're developing for production, let's say a coal mine, for example, that whilst you're preparing it for production, there's some byproducts and you're selling those. In the past, people used to, well, practice was diverse, but some people would have taken the proceeds on the sales of, say, any coal produced prior to the mine being commissioned against the cost of the asset. This is now prohibited, and you would now need to recognize any revenue arising from pre-production activity in your P&L together with any associated costs of production. And this, personally, I think is where it might get a bit tricky to apply in terms of, if you're developing an asset, how do you identify those costs that were incurred in producing this, say, coal in my example? That might be a bit of a challenge, but again, something to look at, but and develop an accounting policy for. In terms of application or initial application, this applies retrospectively, so in contrast to the other one, which was prospective, this amendment applies retrospectively, but only to those items of property, plant and equipment brought to their intended use on or after the start of the earliest comparative period presented. So what does that mean? Well, if you had an asset in development, and again, looking at a December 22 year end, if it was in development at 1 January 21, you would need to apply this to it, but not to any assets where you may have completed development prior to 1 January 21. So moving on to the next slide, and here we're going to deal with an Esma public statement. Esma put out a statement last month in May, and dealing with the Russia-Ukraine conflict and what they expect reporters to say in their interim financial statements. Now, since Brexit, Esma's pronouncements or guidance don't have the same authority as they would have had pre-Brexit, but we're including them here because we think that what they're saying is pretty sensible. It's a fairly short document. It's only 6 or 7 pages, and you can find it on their website. So what have they covered? Well, you see the main headlines there on those 3 boxes. A reminder of IFRS accounting requirements, then setting some expectations about the disclosures they expect to see in interim financial statements. And the final column there is dealing with what other disclosures they might expect in management statements or interim management reports. So dealing with the accounting first, impairments of non-financial assets and financial assets. So clearly, if you have assets located either in Ukraine or perhaps even in Russia, there may be some impairment considerations because they might not be producing what they produced in the past, or producing the cash flows that they produced in the past, and therefore those are normally impairment indicators. Again, in terms of the standards, there's nothing new in those standards that you would look at. So IS 36, but they do talk about, well, if you're doing projections now, people aren't perhaps used to doing projections during wartime, and how you might weight your different scenarios. So they've got some helpful guidance there. Now, helpfully, we've been at least during COVID, we had some experience of this in terms of doing multiple scenarios as opposed to what we might have done in the past, where there may have been just 1 or 2 scenarios. So there's some guidance there. Clearly, discount rates are a hot topic as well. Interest rates are going up, risk is going up. So how those are all factored into your discount rate, again, is something to think about. For financial assets, again, you'd probably be looking at whether there's a significant increasing credit risk, you might need to update your models to factor in new scenarios that you wouldn't have done in the past. Another accounting or potential accounting implication is loss of control, and you know, the relevant standards there, IFRS 10, IFRS 5, if you're planning on disposing of, say, your Russian subsidiary. Now there's a whole host of considerations which again aren't new in terms of the standards, but just as a reminder, you know, a planned abandonment is not necessarily accounted for at the same time as a divestment. So if you've sold something, well, that's fine. You would recognize your loss and disposal, puts it into discontinued operations as normal. Whereas an abandonment, you normally wouldn't recognize that until such time as you've abandoned activities. And again, there may be some judgments there in terms of, well, when does abandonment happen? So moving on to the disclosures, which that was I think, sorry, go back to the slide, sorry. In terms of disclosures, again, if you made a judgment as to whether or not you've, Esma telling you, well, you know, we'd expect some disclosures there. You know, the judgments you're making, say now at June, won't necessarily be the same ones you made at December, so you need to update those. Again, similarly with uncertainties. If there are new uncertainties as you've incorporated into your estimates, again, you probably ought to be updating your disclosures there. And then finally, we've got the going concern risk. Again, is the going concern risk the same as it was at last year? And if it wasn't, your interims should reflect that. In terms of the interim management reports, again, the ESMA have called for consistency. They always do. You know, are your objectives the same? Is your strategy the same as it was at your last reporting date? Probably not. If you gave an indication of that there may be a change, then again you might want to be updating the users of the financial statements with any changes to that. Mitigation measures, again, what risks are coming up, what have you done about them? And they also mentioned cybersecurity risk, which is there's just a heightened or an increased risk of that happening. And the final bullet on the slide talking about the issues, obligations in respect of market abuse regulation, and that's just about prompt disclosure of material information for users. So moving on to other reporting news. And we're now talking about inflation. So if we move on to the next slide, where we've got a slightly scary graph. I'm not discussing anything that's on it, but as you can see, it's all trending upwards in comparison to where we've been over the last 5 years. So the change in inflation will have an impact on some accounting areas, which we are talking about on the next slide. And what are the, if we move on, yeah. So again, we've just listed some here on this slide and the next one, some things to think about. Something might say, well, they're fairly obvious, but inventories, you know, do you have a reduction in your net realizable value? Are your costs of production increasing? And are your sales prices increasing commensurately? If they're not, then you've got a narrowing of that gap between sales, net realizable value and cost, and potentially you might need to be thinking about increasing your inventory provisions. Similarly, increased inflation, reducing demand for perhaps the non-essential items in our shopping basket. Again, you know, you can't assume that previous demand is gonna stay the same. Next one we've got there on this is employee benefits. Again, mainly thinking about defined benefit schemes. You know, inflation has an effect on actuarial assumptions. So you might want to be thinking about whether you would want, say, an interim update to your defined benefit obligation. Again, it's not something that you might have done in the normal course of events, but we're not living in a normal era, unfortunately. Leases there, again, not a widespread impact, but again, if inflation is going up, then discount rates are going up, borrowing rates are going up as well. So, you know, the inflation could have an effect on measurement of some leases, or initial measurement of some leases. And similarly, if you've got an inflation-linked lease, if those inflation uplifts then get bedded in, you've got perhaps an increase to your lease liability. Again, that could have an impact if you've got any gearing covenants, if you've got lots of leases. So it is something to watch out for, to perhaps model as to where the trends are going, in case you need to talk to your bank about covenant compliance. Impairment of assets, again, we've mentioned that before, but we've got listed there potential impacts, which might lead to earlier impairments. And similarly, provisions, contingent liabilities, you might have some contracts that are becoming onerous because, for example, if they were fixed rate revenue contracts. So moving on to the next slide, where we've again highlighted a few other areas. Again, I'm not planning on spending too much time on these, but these are all areas where inflation is an input to inputs normally. So share-based payments, you've got inputs to the pricing models for financial instruments and fair values. You might also see, or we might also be seeing more companies taking out hedging strategies to mitigate against rising inflation. Disclosures in the financial statements, again, you might need to change them or update them to cover off increased interest rate risk. And yeah, I mentioned there government grants. You know, if interest rates are going up, then a loan at below market rate of interest will have an initial lower value than it might have done in the past. So moving on to the next slide, this is just a reminder. We periodically publish a list of economies that are hyperinflationary, and again, you can find that on our website, and there'll be a link in the recording. What happens if you're hyperinflationary? Well, you've got to apply IAS 29 instead of IAS 21, which means financial statements are restated to reflect current inflation rates. And on the next slide, we've got a list of economies that were already hyperinflationary last year or have become in the current year, and on the last column there, a watch list for the remainder of 22. Again, if you've got operations in any of these, it's worth at least reminding yourself of what IAS 29 says you need to do. So moving on to the next slide. So we're now looking at recent changes to IFRS and UK GAAP, and so we've mentioned earlier on about the UK Endorsement Board, and the UK Endorsement Board, just as a reminder, came in to replace the activities that EFRAG used to do in terms of adopting international accounting standards, and they have adopted IFRS 17 insurance contracts in full. Just as a reminder, there were a few tweaks that were done to IFRS 17 as people were working through it. It's effective for next year, so periods beginning on or after 1st of January 23, but you could early adopt it. And just as a quick reminder, and I think we've covered this in previous webinars, that it's not just insurance companies that are affected by IFRS 17, and we'll probably over the next year revisit how IFRS 17 might affect non-insurance companies. So moving on. This is just a reminder of something we covered, I think, in our December 21 webinar. So strictly speaking, not a news item, but this was a submission to IFRIC as to how and when proceeds from a cash electronic transfer should be recognized as an asset. And you see there's a timeline there where you've got, let's say, to take an example, BACS here in the UK, where a customer initiates a cash transfer on 30th of December, but the cash doesn't land in the bank until the 1st of January, actually more likely the 2nd, because 1st is normally a bank holiday. And the IFRIC asked, well, when do I recognize it, or when can I recognize it? And the conclusion was 1st of January or 2nd of January, as I said. And this might be a change to existing practice for some entities who may have recognized BACS receipts earlier than that. In terms of where we're at, the IFRIC have finished their deliberations and considered all the feedback and concluded the discussions, and they have recommended that the ISSB consider it at their next meeting, which is in July. So it is something just we're flagging here for you to keep an eye on. As we say on the last bullet here, the ISSB continues to be lobbied for a deferral of the agenda decision, arguments being that it will disrupt well-established practices and also potentially have wider ramifications. So again, if you want to refresher, go back to our December 21 webinar, which is on our website, but we'll keep you posted on this. And if you think it might affect you earlier, it's probably worth your while signing up to the ISSB's notifications so you find out what happens to this one in July. So moving on. And this is the news that there is no news. So there have been no amendments to FRS 101, which is always good news. And then there's an exposure draft, FRED 80, on the application of equivalence. Again, in terms of how widely this applies, well, it normally affects companies who look to not produce consolidated accounts because a parent, a non-UK incorporated parent, excuse me, because a non-incorporated UK parent is preparing accounts. Now, those accounts need to be equivalent, and this is what FRED 80 is setting out to clarify post-Brexit as to what gaps are considered equivalent. It's out for comments, and comments are requested by 26th of August, but again, not the most exciting piece of changes. So now I'll hand over to Annie, who will deal with other corporate reporting news.
Thank you very much, Moses. So after we've gone through the accounting updates, we're now going to move on to the section on other corporate reporting news, starting with, if we move on, recent developments in the government's audit and corporate governance reform proposals. So if we look at the timeline on the next slide, so I'm sure you've all heard that Beis have recently published their response statement to their previous consultation on restoring trust in audit and corporate reporting, which they originally released in March 2021. Now, this was in response to a number of quite high-profile corporate failures and 3 reviews that were commissioned into the audit market and the UK corporate governance framework, which consisted of Kingman's review of the FRC, Bryden's review of the effectiveness and quality of audit, and the Competitions and Markets Authority market study on statutory audit. Now, this consultation from Beis originally extended until June 2021 and included extensive proposals on areas such as accountability of directors, corporate reporting, supervision of corporate reporting, the audit market, supervision of audit, and so on. And now, what's the latest response to this is that in the Queen's speech in May 2022, the government outlined its draft audit reform bill, in which it outlined its proposals for reforming the auditing framework. Since then, very recently, in May 2022, Beis have issued their full consultation response, which includes some of the proposals to be implemented that were outlined in the draft audit reform bill, as well as some additional proposals. Now, because this audit reform bill is in draft, this means that it's unlikely to be finalised imminently and certainly not within the next parliamentary cycle. Instead, it's likely to take several years for the proposals to be implemented. Some of them will be implemented through primary legislation, for example, through the passing of the audit reform bill, and others will require secondary legislation to be passed. So those that only require secondary legislation will be quicker and easier to pass. Finally, some of the proposals will be implemented in other ways, for example, through the FRC, the Financial Reporting Council as it stands, or else through ARGA once it is formed, and we'll discuss briefly who and what ARGA is intended to be in the next slide. So this would be, for example, in respect of proposals that would be implemented through changes to the Corporate Governance Code. Moving on. So as I said in the previous slide, the proposals outlined are extensive and we're not going to run through them in great detail today. However, up on the slide are some of the key changes. And those highlighted in orange, I will briefly discuss now, and then we'll focus in the next slide on some of the proposals that will specifically have effects on corporate reporting. So firstly, ARGA. So ARGA stands for the Audit, Reporting and Governance Authority. And ARGA is proposed to be the new statutory regulator that will replace the FRC. Its powers will extend beyond the existing powers of the FRC. So, for example, it will have the ability to direct companies to restate their annual reports without taking them to court, which is something the FRC isn't currently able to do. They will also have the ability to sanction directors for breaches in respect of audit and corporate reporting. Secondly, currently, companies don't need to assure non-financial information in their financial statements, their annual reports. It's normally outside the scope of a statutory audit. Under the proposals, there will be a requirement for companies to set out how they assure the quality and reliability of this non-financial information included outside the financial statements. For example, this could be in respect of internal controls or climate risks. Finally, currently the FTSE 350 primarily, well, the FTSE 350 market is dominated by the big four audit firms. And the proposal is that FTSE 350 companies will either need to appoint an auditor from outside the big four or else allocate a certain portion of their audit to a smaller firm in what we call the managed shared audit regime. Now, as a fallback, ARGA will actually be given the authority to set a market share cap, and they would probably exercise this authority in the event of another significant corporate collapse, or for example, if they felt that they needed to intervene once they had a chance to see how the managed shared audit regime is working in practice. So moving on to the specific corporate reporting effects on the next slide. So firstly, the definition of a PI will be extended. Now, currently PIs include companies listed on a regulated market, banks and insurance companies and building societies. It's proposed to expand this definition to include some of the largest private companies, those with over 750 employees and with turnover of greater than £750 million. It's expected that the change in this definition will likely bring in the region of 600 or so companies within the remit of the regulator. Secondly, in respect of internal controls, there will be a strengthening to the current UK Corporate Governance Code requirement, and boards will be required to explicitly provide a statement on how they view the effectiveness of their internal control system. They'll also need to explain how they've assessed that. PIs will then need to provide a statement of whether they intend to seek external assurance over this, and this will be part of the minimum required content in their audit and assurance policy. Then the next proposal is for a resilience statement. Now, a resilience statement is a statement of what a company considers to be material challenges to its resilience in the short and medium term, and companies will need to explain how they've assessed materiality for these purposes. So this will be a statutory requirement for PIEs and will replace the current UK Corporate Governance Code going concern and viability provisions that are effective for premium listed commercial companies on the main market. There won't be a mandatory period set over which companies will need to assess this, so they'll have discretion on determining what they consider to be medium term. They will need to disclose the results of a minimum of one reverse stress test in this resilience statement. Then in respect of dividends or capital maintenance, large PIEs, or for UK groups, the parent company only, will be required to disclose their distributable reserves. And also directors will need to provide a statement on the legality of dividends and some narrative on their distribution policy. ARGA will be releasing some guidance on what is considered to be realised profits for these purposes once it has been established. So we'll now move on to the next slide, and we'll be looking at some recent activity from the regulator, starting off with the thematic review on discount rate, which was published recently by the FRC. So why did the FRC choose this topic for preparing a thematic review? Well, the calculation of discount rates and discounted cash flows is required across a number of international financial reporting standards and sections of FRS 102. Constructing an appropriate discount rate can be complex, and thus it's often a significant area of estimation uncertainty. The standards don't always set out explicit requirements around how to calculate them, and as a result, this can be a challenging area of accounting and one in which errors can be made. Although discount rates don't necessarily appear directly in the corporate reporting review team's top 10 matters of challenge, they often appear indirectly because, for example, they're crucial in certain areas of accounting, for example, in impairment reviews. And as Moses has alluded to previously in the section on interim reporting, this is a particular relevant topic at the moment, given the current interest rate environment. We're in a world currently where we've got low nominal interest rates and relatively high levels of inflation, which makes disclosure of discount rates even more important. So the thematic review, it sets out targeted improvements, well, targeted suggestions for improvements in disclosures on discount rates to make them more helpful and useful. And on the next slide, you'll see that the FRC broadly collected these recommendations into 3 areas of focus. So the first being that assumptions used for discount rates and cash flows should be internally consistent. So what we mean by this is that risk shouldn't be counted twice. So where cash flows are not adjusted for inflation, then it should be a real rate, i.e. one that does incorporate inflation, that is used as the starting point for constructing a discount rate. The thematic also highlighted the fact that in IAS 36, it explicitly states that a pre-tax discount rate should be used for value in use calculations. Now, theoretically, if you use a post-tax discount rate and apply that to post-tax cash flows in order to calculate value in use, this should theoretically give you the same result as applying a pre-tax rate to pre-tax cash flows. But entities will often use the first approach, the post-tax approach, because theoretically this gives the same answer, and often it's easier to adjust your cash flows for tax than your discount rate. If an entity is doing this, then the FRC stresses that it must explain it is doing it, and will also need to assess that this does actually materially give the same result. A key point that was also raised in this thematic was that companies should consider whether, say for example, where they don't have any internal expertise or where it's a material item that needs to be valued, that they should always consider whether they should get in a specialist third party to give them some advice. And they should also factor that into their planning process to ensure that there's enough time to do this. Finally, on the next slide, the FRC stressed the high quality and the importance of high quality disclosures, particularly where discount rates are considered to be a significant judgment or estimate. It indicated that the rate used should be disclosed and it should be explained how it was determined. It should be identified the extent to which risk and inflation have been included in either the cash flows or the discount rate. And finally, the management commentary should be clear and consistent with other disclosures in the financial statements. So moving on to the next FRC publication. This was its first FRC lab insight into current market issues. And this was issued recently and was in respect of supply chain disclosure. So it explores some questions for companies about supply chain risks and associated reporting. So why is understanding the impact of supply chains more important now than ever? Well, I think we've all seen the effect of COVID-19, geopolitical and recent macro and economic events. They've had a significantly disruptive effect on global supply chains and put immense strains on borders. Similarly, we've also seen a marked change in consumers, customers and investors' values, which has changed demand and also had an effect on how companies operate. There's a growing demand for increased regulation around sustainability reporting because of its effect on entities' enterprise values. Ultimately, supply chains have a key role in creating long-term value for business, and this is why investors are keen to see clear and concise disclosures on supply chains. So this lab insight, it sets out some questions and resources that might be useful for companies to consider when they come to prepare their reporting on supply chains, grouped into the three key headings on screen. I think the key thing to take away from this lab insight is that although macroeconomic events and changes in customer behaviour might not have a material effect on all companies, for those that it does have an effect on, investors are keen to understand how companies have assessed the related risks and opportunities. So the final FRC publication that we wanted to talk about today on the next slide is a report from the FRC on modern slavery reporting. So at the moment, this is an area of increasing government attention, and you can also appreciate how stakeholders are keen to gain an insight into what companies' corporate governance arrangements are in respect of modern slavery. So the report summarised research into 100 major listed companies on the main market and considered their modern slavery reporting. What is meant by modern slavery reporting is twofold. So firstly, there is the modern slavery statement. This is a mandatory requirement for companies which have turnover of over 36 million and is required to be uploaded on a company's website as well as maintained on a government register. In terms of related annual reporting, there aren't necessarily any specific explicit requirements for modern slavery reporting in either company law or accounting standards or other areas. However, different sources of requirements will often implicitly require reporting on modern slavery. So in the corporate governance code, there are some provisions that could result in this. The big one is probably the section 172 statement. So in this statement, directors are required to disclose how they've had regard to the interests of employees and wider stakeholders, how they fostered relationships, business relationships with suppliers, and how they've maintained high standards of business conduct. So you can see why that might be an implicit requirement for modern slavery to be mentioned within that statement. Finally, you've got the non-financial information statement, which is a requirement for certain entities under company law. And in that statement, entities need to disclose how they've had respect for human rights. So the key findings and recommendations from this report are listed on screen. I'm not proposing to go through them in a vast amount of detail. I think the key thing to pick out is that it was identified that there was a lack of engagement and disclosure on these issues within the section 172 statement. some of the recommendations were to improve consistency, and then it also provided recommendations of where disclosure could be improved in certain other targeted areas. Then finally, on the subject of modern slavery, another announcement in the Queen's speech was that of the Modern Slavery Bill, which some of the main elements of this bill actually were relevant to financial reporting. For example, this bill proposes to increase the scope of what's required to be disclosed in the modern slavery statement, and will require entities to set out how they prevent modern slavery in their supply chain and operations. Finally, another thing that this bill proposes is the ability to introduce, or the introduction of, civil penalties for companies that fail to comply with the requirements. The next thing we're going to discuss is, if we move on, is a new FCA listing rule, the details of which are on the next slide. So this new listing rule requirement is applicable for financial years beginning on or after 1st of April 2022. And it's designed to provide more transparency over the disclosure of gender diversity of listed company boards and executive committees. Those entities within the scope, which will be UK and overseas issuers with premium or standard share listings, with some exceptions, will be required to disclose certain information on a comply or explain basis. Some of the key elements of this listing rule are that they will be required to include a statement in their annual report, setting out if they have met specific board diversity targets listed on screen. Then such entities will also need to provide certain ethnic and sex or gender diversity information for the board, senior board positions and executive management in a tabular format. As I said, the rule doesn't actually mandatorily apply until 1st of April 2022. So the first reporting periods it will be effective for will be your March 23 year ends. However, the FCA does encourage voluntary early adoption. And we are going to conclude this section of other corporate reporting news with a brief update on sustainability. So in our last webinar in April, I think it was, 2022, we provided some detail on 2 exposure drafts that the ISSB had released. So in these exposure drafts proposed 2 new sustainability disclosure standards, S1 and S2. So as a reminder, these exposure drafts are open for comments until 29th of July 2022. We just wanted to make you aware of a virtual outreach event that the UK Endorsement Board are running this Thursday, so a little bit short notice, but it's taking place from 12:30 to 2 p.m. on the 30th of June, and you'll receive the link, which is on screen in the slide pack after the webinar. And we'd strongly encourage you to sign up for this because it's looking likely to be a really useful and informative webinar. In the webinar, you'll be able to listen to users and preparers of accounts in discussion with the ISSB in terms of discussing what the emerging challenges are and what the UK Endorsement Board has identified as emerging challenges in their draft comment letter to these 2 exposure drafts. So that's something to put in the diary if you're interested. It should be a really useful and informative session. So that concludes the main content of today's financial reporting update. Just before I go over to Anthony to see if there's any questions that have come in that he'd like to answer in person, I'd just like you to be aware of something new for this quarter's update. We are going to provide you with a survey link automatically after the webinar, and it will also be circulated in the Q&A chat function and by email when you receive the slide pack. And it's a link to a survey which we'd really appreciate if you take the time to complete, because it relates to which topics you'd like us to cover in future webinars. So the idea is that if we get this information from you now, that we'll be able to tailor these webinars to better meet your needs in the future. Okay, so I can see that there's no open questions. I believe that Anthony has been able to answer some of them while we've been on. So in the absence of any further questions that require live responses, I'd just like to say, yeah, Anthony.
Hi, Annie. I seem to have lost your voice, but I'll just quickly mention the questions. Yeah, I've included typed answers, but just quickly through them for those who hadn't seen them. There was just a request to clarify on the IAS 16 effective date. Well, if we take the first year as being to December 2022, then the critical date for determining whether an asset falls within the scope of the amendment becomes the 1st of January 2021. So if the asset's being completed and ready for use before 2021, you don't retrospectively apply the changes. But if the asset was still in development on or after the 1st of January 21, then you do need to retrospectively apply this amendment to those to that particular asset that was still in development in the comparative year. And obviously any new ones where development has started since then. Another person asked about what uncertainties we'd expect from a macro perspective at June 22 period ends. Well, I mean, there's many uncertainties in the world right now, but some I would pick up on. Clearly, the ongoing impacts of the invasion of Ukraine, thinking about volatility in prices, whether it's energy, whether it's commodities such as wheat and some precious metals. Also thinking about rising inflation generally, and impacts on economic growth, interest rates, another one. And also thinking about uncertainty around supply chains generally. As we know, they're one of the drivers of inflation. What impact would sort of supply chain constraints have on your business? And then the third question was asking, well, given things are unclear, what should large private companies be doing about the corporate governance reform? I mean, it's a very fair point that the data are unclear. It will depend on whether the FRC can make amendments or introduce changes already, or whether it needs new legislation, the form of that legislation. But I think it's not unreasonable to think that some of these will be effective in 2024, more coming through 25, 26, etc. So 24 is not so far away when you're talking about developing new management processes, governance, internal controls, assurance over internal controls. These are all quite hefty projects. I think it's one of those situations where beginning early will help. It will help you think. It will help you plan. And I would say none of that work will be wasted, because I wouldn't look at these amendments and these new requirements as being purely a compliance exercise. I would say the things to be embraced of ways to improve the way your business is run, the risks are managed, and over the long term, the business is more successful. So I would advise starting early, get the planning in early. Obviously, no one wants to invest money beyond their needs, so perhaps incrementally approach. But at the same time, as I say, I think these changes will improve the way your business is controlled, the way you manage risk, and ultimately increase the resilience of the business over the longer term. So with that, I will hand back to Annie to close the session.
Thanks very much, Anthony. Yeah, so thanks, Anthony, for providing those responses during the webinar. Just another further reminder to complete the survey. We'd appreciate that. But otherwise, I'd just like to say a massive thank you for taking the time to attend today. And we will be back next quarter with the next financial reporting update. Thank you very much.